You bought a home that doesn't rent. It doesn't perform, right? It's like you're invested into your home, a roof over your head, which will in return over time add to your net worth.
Are you covered for the worst case scenario? If you're not, why am I giving you my money? Most people think that you need a job, tax returns, and a perfect credit score in order to qualify for a mortgage loan. But what if I told you that there's a way to finance your next rental property without showing any income at all? This mortgage loan product has helped thousands of people scale their investment real estate portfolios. But if you don't use it right, you could potentially lose your deal or be stuck with fees that you weren't expecting. Today, we're going to cover the 5 biggest mistakes that people make when they apply for a rental property mortgage loan and how you can avoid it. I'm Peter, and this is Jason. We're the Clear Close, the mortgage experts that help you get clear to close on your next mortgage. And if you're in a rush, no worries. We value your time, so go ahead and take a quick screenshot of this. It's going to be the basic summary of what you need, and then you can come back to the video later. But before you go, please give us a like and subscribe to the channel so that way this video can potentially get pushed out to more people that could benefit from this information. All right, thanks, and back to the video. Today, we are talking about the investment side of real estate, but not from like a big investor, like institutional investor side. We're talking about like someone who might want to dabble into real estate as diversification, or like they're wanting to get their first rental, right? They don't really know how they can seemingly afford another house when they're already paying a mortgage.
I guess you could say it's a common concern for a lot of folks because everybody's just so stuck on the traditional way of just like 20% down and qualifying with your income. Do I make enough? How do we even make that work? Or it's like some people have amazing income and have 10 financed properties already, including their primary, and successfully built their rental portfolio out, and now you're stuck because you can't get another conventional loan. There's other programs out there, like this one.
Yeah, so without further ado, the name of this mortgage loan product is a DSCR. That stands for Debt Service Coverage Ratio Loan.
You have to have good credit, though, in order to get it, but yeah, with the DSCR loan, simply put, it's basically how you can buy a rental property without using like employment income, because we're going to look at just the home and its ability to repay on the debt that it has.
So it's not your income from your job, it's income that the property potentially could generate.
Correct.
Jason, just so that people like they know what we're talking about, is DSCR loan specific only for business? Like it has to be business purpose use, or can it be something where someone can use into their primary home?
Oh yeah, no, that's definitely a big no-no when it comes to DSCR loan. It's geared for investment purpose. So you are not supposed to be occupying it at all. So you can't use it for that purpose. That would be illegal. It would be mortgage fraud.
Yeah. So don't do that. Don't do that, people. Is this limited just to residential, or can it be used for like a commercial property as well?
It's a good question. So like with DSCR loan, it's more that it's a methodology to confirm like how we can qualify you income wise, right? So it's an income calculation method. So with these DSCR loans that we're talking about today, they were residential DSCR loans. So it could be single family homes, 2 to 4 units. And depending on the investor and lender, it could be up to 5 or 100 units, right? So it could be beyond just a traditional residential. It could be a commercial residential property as well. I guess you could say towards residential home financing for investment properties, for non-owner occupied homes. And again, DSCR is just one type of methodology in non-QM lending, because there's other options like asset depletion or profit and loss, 1099s, bank statement loans, personal or business bank statements. It just depends on the use case. So like you said earlier, non-QM, it's just non-conventional mortgages.
DSCR loan, we're talking about getting a second, third, or fourth home or house under your name, but you're using someone else's their rent payment to qualify for this loan. All right. So now that we got all that out of the way, what's mistake number one?
So I guess mistake number one is just misunderstanding what that rental income is to like help you qualify, because it's not like a conventional loan where your W-2 income will get you this amount of house, right? the type of income that that asset class can generate, like a short-term rental versus a long-term rental, will have different ways of qualifying. Because with the short-term rental, you're going to need other short-term rental income verification methods like AirDNA or other short-term rental appraisals versus a long-term one. Because, say, for example, in Big Bear, California, you can have a short-term rental on those beautiful A-frame homes, right? And it
Mm-hmm,
could be making $8,000 a month. But on a
mm-hmm.
long-term rent schedule, which is a traditional 12-month lease, that might only generate $2,000 a month. So that's a huge
Right.
disparity. So you just got to make sure you're talking with someone like us to verify you're going down the right path with the right program and product. There's hundreds, if not thousands, of variations of this program out there.
Mistake number two is you can't assume that one loan, one DSCR loan, covers all different types of loans. There's variations and there's different purposes and there's different use cases that you want to use your house for, like whether it's a short term or a long term rental, right? And you need different types of lenders or different types of products to get you across that finish line.
Oh yeah, absolutely. Because just because lender A said no, but lender B is the actual end investor that would have kept the loan anyway, they can do things like make exceptions. So I've had cases where we had a really strong applicant and a property and everything matched up, but their guidelines said you needed 9 months of reserves. Well, we brought that to the investor and they're like, yeah, you know what, we don't need 9 months of reserves for this one. This one's such a solid deal. It's 60% down or low, or like a very heavy down payment and low risk. It's like, we'll just take 3 months in this case, you know? So it just depends on who the lender is. Because again, that's just one example of what I've seen in the past. Or another will say, you know what, this is a type of property that we've seen succeed for other clients. We will make an exception to take it at 15% down, right? And
Yeah.
it just really just depends. And that's the crazy part about these programs. It's not like a conventional loan. That's the beauty of it. You have unique use cases where you can pivot and make sure that you have a way to continue to acquire and build your portfolio the right way.
You wouldn't advise me to go to like Bank of America or JP Morgan Chase and he'd be like, hey, can I get a debt service cover ratio
They're gonna be like, I'm sorry,
loan?
we don't have that product, you know?
They
It
would just
doesn't exist.
refer me to a commercial loan officer and get a business loan, right?
Probably they would low key refer you to a commercial loan
Yeah.
officer.
The third mistake is don't sleep on the fine print. This is the same advice that we would give to anyone doing any kind of loan, any kind of contract.
Don't sleep on the fine print is one thing that I think was really important that we have to highlight is the personal guarantee nature behind it,
Right,
because
right.
that part is such a big issue in my opinion that's under addressed in the social media community. Because I see so many people ask me like, or tell me, hey, I saw this on YouTube or Instagram, I bought it in an LLC, so it's not going to show up on your personal credit. Yes, it's a business loan, right? And yes, it's business purpose and it is owned by the business entity. But just like some of those credit cards you have, there's personal guarantees that you make. So in case
Yeah.
of default, the lender can come after you and your personal assets, right? To be made whole in case that foreclosed on property, they didn't recoup what was guaranteed, right?
Yeah, and in my experience with personal guarantees, they're usually a separate contract outside of the main contract. So it's like they when when you get the documents to sign, you sign the loan agreement and then you sign a personal guarantee. So yeah, if you don't know what a personal guarantee is, Google it or click that link in the description below. Schedule a one-on-one consultation with us. We will explain to you the implications of a personal guarantee on a DSCR loan, and we'll walk through with you step by step what it takes to be successful in your next mortgage. Moving on to mistake number 4 is not planning to have reserves. So this is this is kind of hand in hand with overextending yourself, right? Like you need cash reserve. You can't just go YOLO all in into one property with with nothing in the back. Like
Okay.
you don't have a backup plan basically.
Mhm.
Like you can't empty out your savings and your piggy bank to go into a DSCR loan for down payment.
You can do that on your primary home in most cases if you're well qualified,
Hmm.
but definitely not the case with investment properties. You have to make sure you prepare. Like Peter always says, right? You have to plan out the worst case scenarios. Sometimes I have to admit I plan out the worst case scenarios to the worst extent, but it helps me. It helps put me at like it puts my mind at ease knowing that I'm prepared for the worst if it happens,
Right.
right? And then it's like if it doesn't, then it's like I know exactly how to pivot and I see where my floors are or my ceilings are,
Yeah.
and it just keeps me within in the rails, right? So it's a common thing like people don't talk about. Some loan officers don't explain it. It just blows my mind when I see it or hear it. Like, oh, they just told me I need to put 20% down. I'm like, but you don't have reserves to qualify, right? You don't have you still need to save up money for the closing costs, right? You're
Right.
banking on something to someone to pay that for you. Maybe you'd be lucky, but
What if you don't?
you need to
Yeah.
have your
What
own
if you don't
reserve.
get a renter in there right away? What if you don't get a
Yeah, what are
VC
you
in there
gonna
right away?
like it's like what's the worst case scenario? You bought a home that doesn't rent. It doesn't perform, right? It's like that's the worst scenario. That's the worst situation,
And
right?
guess who else thinks about worst case scenarios and plans for the worst case scenarios? It's the lender. The lender. They're gonna want to see, are you covered for the worst case scenario? If you're not, why am I giving you my money? Right?
Oh, 100%. It's like if you wouldn't lend money to yourself, yeah, this is not gonna
Trust
work,
me,
you know?
bro.
Man, I feel like sometimes when we share some of this stuff, it's like we're discouraging people from either buying a house or something. But it's like the side that people need to hear too, right? It's not all grass is greener and flowers and butterflies and everything.
Oh no,
You
yeah.
gotta be smart.
Well, there's immense opportunity out there, but there's also a risk. Like, and we
Mhm.
gotta look at the risk just as much as the opportunity and balance the two, and then go into this, or go into whatever business or investment with both perspectives. All right, let's move on to the fifth and last mistake that people make when they apply for a business purpose or rental property mortgage. Rookie mistake is having sticker shock because these things are not cheap. This is not the same as buying your primary home using a conventional mortgage. You kind of have to have a paradigm shift when you're talking about investment, because when you're looking at a primary home or primary residence, you don't want to look at it
Mhm.
really as an investment. You're looking at it as a place to live, right? To keep your family safe, to grow your roots, to build your community. But when you're looking at when you're using a DSCR mortgage loan, you're looking to make money, and in order to make money, you got to spend money.
Mhm. That's the funny part because like it happens with people even just first time home buyers buying a house or repeat home buyers. They're like, oh shoot, I totally forgot. It's not just the down payment, it's closing costs, it's moving expenses. It's like how much does it cost to prepare this house to get it back on the market, right? Because like, you might have got a smoking deal on the DSCR loan and the purchase price, but what's it going to take to turn to get it on the market, right? So it's like don't be you do a little bit of due diligence, speak with Peter or I or Nikki, and just see what your options look like going forward with any type of investment.
And just so everyone's kind of focusing back on the goal here, the goal is to make money. And in many cases, you might not see positive cash flow from a rental property. You might be like just breaking even, which is still really, really good because you've acquired a huge asset. Like if it's $1 million home, like, or let's say it's between 600,000 to $800,000, that's a big asset.
If you want to do the math on DSCR on that house, for example, you'd have to put down like $1 million, you know, and then you'd have a $500,000 loan, and then you would see break even or a little bit of cash flow, right? Or it'll cover all the unexpected surprises and maintenance. But what you're getting is a $1.5 million asset, and the cash on cash return is a different calculation because now you have $1 million that you put down into that home, and that home will appreciate at 4 to 6% in this neighborhood. So that if what is one point? What's the calculator? Let's bust out a calculator, Peter. What's a $1.55 million home appreciating at 5%? You just made $77,500 in equity in appreciation.
Mm-hmm.
So on $1 million, that's a 7.75% return.
Yeah, it's like stock market.
That's pretty damn good, right? So it's like it's diversifying. You have it, and then you have a different
Mm-hmm.
approach.
Yeah, we just had an episode talking about the value of asset appreciation of a home.
Mhm.
Like when people don't really consider the equity that a home can bring to you in terms of offsetting
Mhm.
the money leaving your bank account, right?
Yeah,
You're increasing your equity over
that's
time.
exactly like exactly what we talked about last week. So it's like
Mm-hmm.
that was our conversation on renting versus buying a home, and
Right.
that is such like it's hard for people to quantify it because they don't know how to calculate it. But if you really sit down and figure out what that growth in net worth really looks like, you're diversifying. You're not just invested into your retirement account.
All right. So if you've gotten this far into the video, we really appreciate it. That's it for us today. We hope you guys got something out of it. And if you are interested in beginning your journey to becoming a real estate investor, growing your real estate portfolio through these rental property using a DSCR mortgage loan, go ahead, click the link in the description to schedule a one-on-one consultation with us. Our team is here and ready to help you out with the next big project that you're going to be working on. Remember, we're the Clear Close, the mortgage experts that help you get clear to close on your next mortgage. We'll see you guys on the next one. Bye-bye.